This is an uncovered Japan company research report on Mirait One, ticker 1417. Mirait One is Japan's third largest telecom infrastructure builder. It has a decades-deep NTT relationship, and it is broadened through acquisitions into civil engineering, data centers, and geospatial intelligence. The central question is simple: can that wider platform lift the sector's lowest operating margin? At the report's reference date, Mirait One traded at 13.2 times forward earnings and 1.21 times book value. Its FY26 operating margin recovered to 5.7%, while return on equity reached 8.3%. Those figures are respectable, but they also tell us that the old below-book bargain has gone. The remaining case depends on operating improvement. Telecom construction is physical work, laying fiber, building base stations, and wiring network facilities for carriers that own the network but outsource the build and maintenance. Mirait One is trying to capture more than that legacy task. Its group can combine survey and planning, civil construction, electrical and telecom work, then ongoing operation and maintenance. Data center projects are especially important because they require power, cooling, and network capability together. The 5-year financial chart makes the setup clear. Revenue grew from roughly 470 billion yen in FY22 to more than 600 billion yen in FY26, helped by acquisitions and infrastructure demand. Profit did not rise smoothly. Operating profit fell from 32.8 billion yen to 17.8 billion, before recovering to 34.3 billion. The turnaround is visible. The debate is whether it can turn into a durable margin step-up. This group sales view shows why Mirait One is more than one operating company. The legacy telecom core accounts for just over half of external sales, surrounded by regional telecom subsidiaries and ICT businesses. Seibu Construction contributes civil engineering capability, while Kokusai Kogyo adds aerial surveying, geospatial information, and disaster consulting. Together, these acquired businesses create a broader bid for social infrastructure work, but they are also part of the group-level integration and margin challenge. The important comparison is not simply revenue growth. Mirait One's FY26 operating margin of 5.7% remains below COMSYS at 8.1% and XEO at 6.6%. The company has deliberately bought breadth, but that breadth has not yet produced peer-level profitability. If the margin moves toward the peer range, earnings rise, and the valuation discount can narrow. If it remains in the fives, today's valuation is much harder to defend. The acquisition campaign changed the capital structure, but it did not leave a fragile balance sheet. The equity ratio settled at 48.7% in FY26. Return on equity fell to 5% in FY24, as profitability weakened, then recovered to 8.3%. Management's stated target is more than 10% ROE. That target is credible only if the operating margin recovery continues and acquired businesses generate the intended returns. Construction makes annual cash flow uneven because projects consume working capital before collection. That is why the cash flow chart swings sharply from year to year. Still, free cash flow turned positive in both FY25 and FY26, at about 13 billion yen in the latter year. The balance sheet conclusion is not that every year will look smooth. It is that the underlying business can generate cash once we look through the construction cycle. Mirait One's established moat has two parts: a decades-long NTT relationship and a nationwide network of crews and local operating knowledge. Those are difficult for a new entrant to recreate. The newer moat is management's 3-in-1 proposition, combining Kokusai Kogyo's planning, Seibu's civil work, and the telecom core. It produced 9.07 billion yen of FY25 synergy orders against a 30 billion yen target. So it is promising, but not yet proven at scale. The macro backdrop is the strongest part of the thesis. Generative AI and cloud investment drive data center construction, a market that needs the exact combination of power, cooling, and network work Mirait One can offer. National resilience, local government digitalization, and renewable energy investment add further demand. But a favorable order environment does not automatically create higher profitability. Labor and materials inflation mean pricing discipline and project selection remain central. The report's 3-year scenarios are the author's estimates rather than company guidance, and they make the risk-reward transparent. The bear case is around 2,800 yen if margins stall. The base case is about 4,100 yen, which assumes management reaches its 6.5% margin target. The bull case, near 5,500 yen, requires a genuine move toward peer profitability. Every path depends on the same watchable variable: To close, Mirait One is a real Japanese social infrastructure franchise with unusual breadth, a strong macro backdrop, and an improving financial profile. But the easy valuation repair has already happened. From here, the investment case is a margin recovery case. The practical indicators are operating margin, 3-in-1 synergy orders, the mix of data center and operation and maintenance work, and the next midterm plan. This is research, not a recommendation. For a much deeper look, visit the free deep dives at uncoverjapan.com. We go beyond the headline numbers to cover the business, financials, valuation, risks, and catalysts. This video is for information and education only. It is not investment advice or recommendation to buy or sell any security.